Hi, everyone, and welcome to those in Northern Europe who have been on holidays like myself for the last 3 weeks. That has been very nice for me and my family, so I'm happy about that. I hope all of you in the north of Europe have had somewhat similar experiences enjoying the rainy weather and everything that we have to, bask in as Northern Europeans. David, you've been working all through summer because you're in Portugal, am I right?
You're absolutely right. Here we tend to take holidays later, and I'm one of the late bloomers. I'm only going end of summer, so I'm super jealous of people like Andreas in the north of Europe that seems super fresh and energized, and I'm here like feeling I've been working for 2 years straight. Anyway,
One, one espresso in, and I already feel jittery from it. So that is something that normally does not happen during the normal days. We've also got Mark with us here today to talk about how to value deals and assess risk return potential when looking at investments in connection to your investment strategy. Mark, you're in Germany, Berlin, am I right?
Yes, you're right. And summer is very different this year. It's actually very cold and rainy. So July has been a big disappointment. But let's see what August brings. So,
And speaking of big disappointments, let's try and not create that too much here. Today, as I just said, we are talking about how to evaluate deals and assess risk return potential in those deals. And we have an emphasis on this being deals. And why do I say that? It's because I really want to make sure that none of you are sitting there and thinking that you're going to know at the end of this webinar or discussion how to assess a startup, because how you assess a biotech startup or a fintech startup or a SaaS business is completely different. So it would be very difficult to do this with us being vertical agnostic. So for that reason, what we're focusing on here is the deal dynamics around doing an investment, irrespective of what vertical it might be in. And then we are putting a lot of emphasis on tying that to your investment strategy as an angel. And we're doing that because that is what we're seeing as one of the big risk factors or pitfalls in your investing, is that you kind of get super excited about a deal because Speed Investor doing it, or Cocoa, or Seedcamp, or something like that, and you've got an allocation, so now you're going to plow a lot of money into it because this is going to be a great one. And then you forget about your investment strategy that told you to not do more than 5K investments or something like that. So we're trying to really tie this topic of assessing deal opportunities and linking that to your investment strategy. And Mark will take us through a lot of his frameworks to do exactly that. We just did the small intros, or at least some small funny talk about the summer holidays. But Mark, maybe you would just give us a bit of a brief overview of who you are, what you're building with Altitude, and why you're relevant. You're a relevant person for people to listen to when talking about angel investing.
absolutely, it's going to be my pleasure. So I have an entrepreneurial background, but several companies, and then I actually moved into VC, and out of VC, I turned an angel myself with a portfolio of roughly 30 companies. So I've seen both sides: investing as an angel, investing as a VC, and as a premium as well. So the other side, being an entrepreneur, receiving an investment from angels and VCs. So I think I can combine all views. And eventually, after doing all that, I kind of decided to build my own VC with Altitude, and we're trying to bridge the SME tech gap. So we're focusing on two main areas. We're investing into companies which build services or solutions for SMEs. And there's two subtopics. One is automation, the other one is sustainability. And we have one very particular angle, how we see angels and how we envision to work with angels as we engage them, sharing the deal flow with us to jointly invest with us. And I think this is the very interesting part about myself. Why do I qualify to share my opinion, my views? I think it's the overall view from all perspectives on the table, how to invest, how to compile an angel portfolio. And when I started investing as an angel back in the days, I think I took all my knowledge from being an entrepreneur and being a VC and tried to kind of copy paste that into angel investing. So when I started, I think I started without a strategy per se, and the strategy arose while I was doing that. And looking back, I did probably some mistakes. I was still lucky. But I think I kind of derived my own strategy and kind of copy pasted it in towards what I'm doing today.
Thanks a million, Mark. David, now I'll ask you to tell us a bit about yourself, but also EUVC, why we're doing this, and also let people know about our podcast, because I think that anyone listening to this will also enjoy very much the content that we're putting out there.
Yeah, definitely. Hi, everyone. Thank you for joining. So I'm David, one of the co-founders of EUVC, and as Andreas said, we're probably best known in the industry for our podcast, the European VC podcast. We interview GPs. We also interview LPs. At the end of the day, it's all about like generating some kind of knowledge or insights that are relevant for the for emerging GPs and GPs across Europe, and hopefully kind of play a significant role on that front. I think of note, and why we're here, or why I'm here, is also because we are angel investors. We have a somewhat different approach than most. We are very, very, very skeptic of our ability to pick, pan-European global tech successes. And so we believe in this strategy where we invest into early stage VC funds. We collaborate with these GPs. We try to build long-lasting relationships and really add value, and then see where that takes us. We have this kind of thesis that we might be able to co-invest at a later stage. We haven't done that yet. It's early days for us. We're still learning. And so participating in these kind of sessions is always super insightful, because we can share our views and our approach, but also kind of get the feel for it from others. And we co-invest with other angels a lot. So it's always cool to get their kind of feedback on that as well. And Andreas, you were kind enough to let Mark on the highlight, just nodding while I was talking.
Sorry, very sorry. I thought so. I was looking at Mark here, thinking he's the most beautiful guy I've seen for days.
That must have been the reason, I bet.
Even though David is Portuguese, Mark, as the German here, is kicking David's hair right out the ballpark. So that's the tough
No
work.
question asked.
Now let's get back to the agenda. So let me just emphasize this again. We're going to be talking about the importance of evaluating deals and assessing their risk return potential in the light of your investment strategy. And for that reason, we're going to spend quite some time here in the beginning talking about investment strategies. And then after that, we'll go into a more open discussion and throughout all of this, shoot all your questions in the chat, shoot all your questions to us. There's nothing we'd like more than be able to make this as engaging as possible and reply to what you might have to ask us. Now, let's get into it and look at the first part of this segment, which is the investment strategies. And Mark, I'd love you to tell us a bit about why you're saying that there's two different angel investment strategies as you see it. There's a Babe Ruth angel investment strategy and the average Joe angel strategy.
Well, maybe we go one step back and just think about like how investment strategies differ from being a VC compared to an angel. I think they completely behave differently. And when I started back in the days as an angel, I thought I can copy paste one to the other. So thinking about like an angel and like a VC, an angel is evergreen. You can invest for 1 year, 5 years, 10, 50 years, as long as you want. On the other side, a fund typically invests throughout a term, 10 years, 12 years, whatsoever. On the other side, if you look and think about like investing per se, well, as an angel, you have your personal liquidity, so you invest when you have money. As a fund, you have LP's money, so it's not your money, and you invest based on how much you can draw down. Thinking about the approach, angels usually are very opportunistic. You have a closed network, you source deals, and you kind of invest when you have the feeling this is something great, something you're interested in, or when you're kind of convinced that other angels or VCs are in that round, that this must be a good deal. A VC on the other side is very thesis driven. So they think about what they want to do. They think about whether the deal fits into their thesis and in their scheme. So that's very different. Looking at decision, as an angel, you basically follow your gut feeling. Unless you have like lots of experience in VC or in that field, you have an unstructured approach. You like the team, you like the deal, so you actually go for it. Thinking about VCs, well, they're conviction based. So they think about the deal, they go run through their criteria, they do due diligence. So it's a complete different process. And most importantly, at the end of the day, when you evaluate your portfolio as an angel, you don't have cost, you don't have fees, you don't have carry whatsoever. So your investment is your MOIC. And on the other side, if you think about VCs, well, for them, they have fees. So what ends up being returned to the LPs is something completely different compared to an angel. So going back to your question, after like kind of structuring the general, why is this different from the other? I think there's two types of angels, and there's multiple ways to start. So I bet there's more types than these two, but these are the most like fitting ones for me. The Babe Ruth angel on the one hand is somebody who has the experience, who has the knowledge, maybe has a like entrepreneurial background, has a VC background, has an angel background gathered over time, and he's very sharp, very precise, very compressed portfolio, knows exactly what he's doing, and most importantly, he's very disciplined in how he's investing. And the average Joe angel is somebody who might have some experience in entrepreneurship or the VC world or in startup world, but he doesn't have like the in-depth experience, the first-hand experience of doing that and knowing what to do, how to do it. He doesn't have the network to source deals like Babe Ruth angel. So I think this type of angel is investing very opportunistically, should be investing very broadly in a bigger portfolio, and most of the time they're not disciplined enough to nail down what they want to do. They're very much led by their gut feeling. They see a deal, they see others, and they kind of hyperventilate and say, oh, Speed invests in that deal or Sequoia's in that deal, I should like put my money there. And there's multiple other factors which I think will deep dive into, thinking about why these types are different.
Very cool, and for sure we're going to dive much deeper. I just wanted to pull up one here from Emad. He says, thanks for the event. Is there a special part where we can ask questions? All of you can ask questions throughout the event. In the end, we'll have a longer discussion part where we might relegate some of the questions to, but when we say something that you think either that's off or I think that I have a view here that I would love to contest this with, put it up and we'll pick it up. We want to make this engaging. And we can also reply to you in the chat. LinkedIn is definitely the place where we are the most able to reply to your questions. So do drop them in the comment there if you're watching through LinkedIn. But now let's get back to this. We already have one question, and that is from Simon. And he said, I'd love to hear your thoughts on the fund of fund investment trend in the VC market lately. It's a bit already going off topic of everything here, but I'm making a point here. We want to take your questions. We've got a question from Simon. I will actually not start with David because we all know that David's view is going to be quite pro this. But Mark just, I think yesterday or the day before, put out a post about exactly how tough it is to raise a fund of fund these days, which I think ties quite well into this question. Tell me,
yeah,
Mark,
by coincidence. I'm very happy to start to take that one. Well, even though it's a little off topic, but I love that topic in general. So I think raising a fund as a VC is very hard. Raising money as a startup is very hard. But thinking about raising a fund of fund, that must be the toughest thing these days. Why? Because you have a double fee structure. So you run your own operations, you charge fees to your LPs, you charge carry to your LPs, and then you give money to somebody who's charging fees, management fees, and carry as well to you. That's what I mean by double fee structure. And just looking at the overall market, I think Europe is still very, very, very small compared to the US. And the US is very, very slow these days. So just looking at the past years, fund of fund raised less and less and less and less every year. And like the massive decline started in 2021, 22, and then 2023, like this year, must be one of the worst years raising fund of funds. And what I did, I kind of highlighted the aspect that fund of funds invest into funds. That's very obvious. But they invest into mature funds, established funds, and they just put a small allocation into emergent funds. So I was kind of arising the question whether it's relevant for an emergent fund to raise money from a fund of fund, looking at the hard fact that they will likely deploy just a small fraction of what they have into emergent fund managers. And looking at the overall landscape, it's just a tiny bit. So the major LPs investing into funds these days, especially into emergent funds, are more likely family offices, high net individuals. And of course, looking at the overall landscape in Europe, it's KfW, it's the EIF, it's the NRW Bank, and like local governmental institutions putting money into these emerging funds to keep this alive. So I think the market is very distressed, but not because it's fund of funds, because the market is the way it is right now. So it's a hustle for all of them: startups, funds, fund of funds, and everyone who's literally raising alternative assets right now.
Yeah, and I'll just ask David to also come in for a reply on this, and then we'll get on to another question, which I think is pretty fun, right after Marc has told us a bit more about what's the Babe Ruth and the average Joe approach. But David, take it away on this question of fund of funds and what we think about those.
I agree with everything Marc said, and I'll be very brief here because I'm obviously very biased because I invest into funds, and I'm also a venture partner at Isomer Capital. In my opinion, the best fund of funds in Europe, if anyone's interested, isomercapital.com. But having that said, I think we've seen a trend across venture, right? We've seen a lot of new funds, and we've seen a lot of new fund of funds, and I think it's exactly the same, right? With the explosion of new capital and everything, a lot of it is good, a lot of it is bad, right? There's a bit of everything. I think it's really important just to understand really well, like if an individual is assessing a fund of fund, just really understanding what are they bringing to the table. Is it access? Is it diversification? Is it is it just kind of an exploratory fund for co-invest, right? I think there are many models that work super well. It's just about being super clear about that and understanding, okay, what is the expected return profile here? Because as Marc said, there is this double fee structure. That might be fine if the motivation is, as an example, get global exposure to Series B stage startups. Well, that's actually a good strategy, right? Ideally, right? And so I just think it's really important to assess like what is the edge of that fund of funds versus like just labeling fund of funds as a good or bad thing. I don't know.
Yeah, and I think if I should just add one thing, I'd say that just because venture is a very good place to be investing right now, if you have the liquidity to do it, it does not mean that it's easy to pick a fund. And that's why some people choose to go with a fund of fund as well. And I think it's also why it's very worthwhile to be working closely if you want to do fund investing with someone who has done it before, because especially in this market, and even venture capitalists, many new venture capitalists are struggling navigating the market, both in terms of what's going on, because if you're a younger investor that hasn't seen the types of markets that we're in right now, you can be caught off guard. Same thing in how you manage your own fundraise. It's not simple. And if you don't know what questions to ask a manager to know if they're going to be successful in their raise or if they're thoughtful about how to navigate their raise, then you can also be caught off guard. And the last thing you want to do is invest in a fund that haven't been able to think through how they will endure through this market. But let's get into the model, and the question that I said I wanted to get to was this question. Let me just pull it up for you. It is from Elodie, and she asks us, how do you describe yourself, Babe Ruth or average Joe? Same question for David. But I think let's leave it for after you've gone a bit more in depth, Marc, because then I think that probably you guys can also guess where we're trending. But Marc, take it away on this, and I'll put it up in full screen for us so you can just see Marc's beautiful bullet points here.
Yeah. So, I said already some words about the average Joe approach, and I think it's a very smart approach. If you don't have access to the right deals, if you don't have like a deeper understanding how to assess deals, especially if you aim to invest into pre-seed, the very hard fact as an angel is there's not too much to due diligence. You look at the team, you look at the deck, you look at the market, and you try to understand whether this makes sense in terms of, hey, it's a product or a service which could be something great or highly relevant. So I think the very first thing is an average Joe angel investor should have a broad portfolio. Like looking at 30 to 50 deals, that's obviously a lot. If you would just put 10K in every deal, that's anywhere between 300 and 500K. So looking at the whole sum, it's a massive amount of money. But you have to consider it's not throughout 1 year or two. You have to, or you might want to invest over like a span of 10 years, maybe 5 years. So it's a long-term game. So when you look at that and divide like the 300K over like 10 years, it's 30K. It's still a lot, But in VC, it's a numbers game. Every VC investment is an asymmetric bet. You either win or you lose. The likelihood that there's anything in between is still there. Yes, it happens, but most of the time it's not relevant. The second one is you want to do equal investments, assuming that you can. If I show you 10 deals, pick the one which is fantastic and pick the one which is still okay, cool, you want to do the deal, and based on that say, I'm going to put 50K in that one and 10K in that one, is wrong. You don't know better. That's the one thing. So sure, you have to be very disciplined putting the same checks, 10K checks, 20K checks, 25K checks, whatever you feel comfortable, whatever you can, of course, provide throughout your liquidity. So I think it's very important to understand, be consistent in your check size because you don't know better. Most of the time you're opportunistic, and you should still invest somewhere across stages. So don't put all your bets in pre-seed. Well, first of all, likelihood that you will only see pre-seed deals is very small. Put some money into pre-seed, put some money into seed deals, and if you have high confidence and get the allocation, even put some money into Series A. This has many important aspects. One is risk diversification. So pre-seed is obviously more risky than Series A. You can see more traction, you can see more insights, you can see if the company is developing the right way, and of course the shareholder base. And the other one is time to liquidity. So thinking about at some point you will divest, of course. A pre-seed investment will take you 10 years to divest, so you have like the maximum output of the company, or not the maximum, but like a very high one. If you're in Series A, this is already 6 years or 5 years down the road from when the company started. So time to liquidity is simply shorter. So investing across certain stages makes a lot of sense. The other one, as an average Joe, I would not put like money aside for follow-on investments. Why? Follow-on investing is something beautiful if you hit the targets. So if you do understand which is the outstanding company of your 10, 20 portfolio companies, then it's fantastic. But as an average journalist, you simply, A, you don't have the expertise, B, it's still a very big bet if you don't understand what you do. So diversification in terms of portfolio size is way more relevant than kind of backing the winner in your portfolio, because if you back that one, you might still be wrong and lose double your money. So I think it's not the right strategy for the average Joe approach. And I think, yes, go ahead.
Could I ask you, just because we got quite a few of, we always talk about this on our podcast when we're talking with super angels, and they tend to be very divided on this. Some choose to do follow-ons and have follow-on reserves, and some don't. If you were to, really say this is when you should do follow-ons, then could you describe that a little bit for us?
If I would do them, well, I do them. I've done them plenty times. And I mean, of course, you see a deal, you invest into a deal, 2 years down the road, they re-raise, and all of a sudden a big player, big VC comes in, or they have achieved something tremendous. And obviously you're like, wow, this is a great deal. I should put more money into that deal. And you're very much led by the halo of other people. So the thing is, if a Sequoia, I don't know, like an Axel or a big investor, Andreessen Horowitz, comes in, you always think, oh, this is a fantastic deal. Well, if you think about their portfolio construction, they invest into 100 companies, still they write off 60 or 70. So how do you know that this is the one which is going to perform well? They like the deal, they check a lot of boxes, it's probably top quartile of the deals, but still it can fail. So I think it's a very risky game, especially if you step up the amount of money you put into these deals. So I think there's nothing wrong about doing follow-ons, but follow-ons always imply that you have a deeper understanding on what you do, and that you obviously have the sufficient liquidity to still follow your strategy as an entry investment only strategy.
Yeah. And then you've got the fifth one, which is various fund investments into emerging and established funds.
Yeah.
Tell us more, and David, I'll ask you to come in on this one afterwards.
Yeah, so for me, it's a integral part of being an average Joe angel investor. Why? Because there's multiple side effects on investing into funds. So one is, of course, access and knowledge. So you can learn from other funds, you get access to deals, you can do deals with them, and you can jump onto deals which they don't do. Doesn't make them bad deals. They're maybe not the right deals for the fund. So you can broaden your network, get a better understanding, get better deal flow, get more deal flow, and you can learn. So these are obviously the very apparent aspects. One aspect which is equally important is you want to balance risk. right? So if you do 20, 30 investments, just look at the hard facts. If you do, as an angel, anywhere between 12 to 15 investments, the likelihood that you will return your principal amount, the money you invested, is 90%. If you invest into 70 companies, the likelihood that you double your money is all of a sudden 90%. So the more you invest, the higher the likelihood that you return a certain amount of money. And of course, it's like a bell curve. It decreases at some point. So it's not like an ever way. The more you invest, the better your returns become. Otherwise, VC would be too easy. What I'm trying to say is if you invest into funds, you can increase the underlying assets. So you have a portfolio of 20 direct investment as an angel, plus 1 or 2 investments into emerging funds, and they have an underlying portfolio of another 30 or 20 companies. So if you sum this up, all of a sudden, you're sitting on a portfolio of roughly 80, 90, or like 100 companies. This will tremendously diversify the risk you're exposing your money to. So I think there's multiple very important side effects that you invest not only into direct startups, but as well have like fund allocations to have more underlying portfolio companies to be just diversified.
Yeah, now David, for a quick comment, because we should get on with it, but please go.
Yeah, just maybe a concrete example, right? So we've been investing as angels into early stage European funds for a year and a half or so now, and are just kind of putting numbers to what Marc said. Our underlying asset list, right, is over 150 startups, and so the pool out of which we could now try and do follow-ons, as an example, or in this case, it would be first direct investments. So it isn't really a follow-on, but that pool is much bigger, and the level of information we have on those companies is very different because we've been tracking them since the first ticket from that VC fund, right? And so I think that's a very good way to put numbers into what Marc said. And that's our example. That's literally our case. And that's why we're now looking at what are the opportunities that we can leverage from that angel investment portfolio.
Yeah, and if I were to just add one thing to what David said, there's also, we have a partner to whom we're quite important because we're an LP in their fund, right? So when we think that an opportunity might be interesting for us, and we want to diligence that and go a bit deeper, we have the VC that we can tap on their shoulder and say, that's an interesting opportunity. Could we talk through that? Though the VC, of course, would likely want us to also come into that deal and have that incentive, they also have the incentive to make sure that we stick with them for the next fund. So it's kind of counterbalanced in that way. But that means that we don't only have their exposure to those 150 companies, but we also have partners with whom I think we can have pretty transparent conversations about the underlying portfolio. So I think that's the very, very sexy thing about that. Before going on to Babe Ruth, I think we have a question here from Philip, which is super interesting. He asks us, do the average Joes always realize they are the average Joe? I have the impression too many of them think they're Babe Ruth. And Philip is, of course, saying this in third person pronoun, third person plural, meaning not himself, of course. So Marc, tell us, what's your views on this, and I'll then pitch in as well.
I love it. I actually already read that question. That's why I was laughing earlier. So it kind of plays into what I think I am or I was and what I turned out to be. When I started, obviously, I thought I'm Babe Ruth. I thought I know it all. Being in VC, you get the hybris, you get the skill set to assess deals, you think you know better. So when I went out, I thought like, oh yeah, of course I have the Babe Ruth strategy and I know it all. Until I realized, no, I don't. I'm not better than everybody else. It's a numbers game. It's asymmetric bets. I have to have a strategy and have to kind of understand what's wrong, what's right, and how can I improve along the way. So the very honest truth is when I started, I was definitely beyond, a little below average Joe. And then I kind of stepped up my game and looking back and looking at what I have today and how I invested today, even in the market where we are, I think I'm more and more primed myself to become Babe Ruth. Am I? No, I don't know. I think I'm a good angel investor. I'm the most fantastic one, surely not. But that's totally fine. At the end of the day, do I outperform the private market equivalent? Yes. So I put my money in the right basket. So I think I'm getting better. I do understand many things. But being an angel, even if you're fantastic, is a lot about timing. You have to be lucky. You have to have this one outlier in your portfolio. Just think about the most prominent example of Peter Thiel when he invested into Facebook very early on and made it 2,200x return on his investment. Did he know? Of course he did. Did he return 1.1 billion? Yes, he did. So he was very lucky. And if you have this one of outlier, you can be wrong 95 times. It's totally fine. You return 2,000 200 times your money with one investment. That's why I'm always saying it's an asymmetric bet you're doing. And I think there's lots of people out there which are very similar to me, saying, oh yeah, I'm super smart, I know this is the best deal. And then you learn, no, it's not.
And I'm deliberately pulling up Petr's question here. That's a follow-up, which is, can you actually, he asks us, shouldn't the average Joe be aware or wary of taking too much risk until he becomes a Babe Ruth? And he then asks if an average Joe can blossom into becoming a Babe Ruth. And Pedro, first of all, is not a stupid question at all. Let me just show you this graph. This is the number of investments on the horizontal axis, and then on the vertical, we've got the median IRR. This is the numbers behind what we've been talking about, right? You want to increase your portfolio size so you get more shots on goal, and you can see that that will improve your performance all the way up to around 100 investments. And this is the strategy that you will want to be, if you're not yet a Babe Ruth and you recognize that you want to be employing, right? Because this is the only way you can do early stage investments without getting, taking on too much risk, as you call it. And then by doing those investments, you're around the table, you're looking, you're observing, you're learning from all the people that you're getting into bed with, and that will then hopefully make you Babe Ruth someday. Mark,
can I just chime in something there? Because I think like the frameworks are a great way to kind of abstract concepts and really kind of help individual angel investors also kind of reflect about themselves, but we should never take them to, in too much of a structured manner. It doesn't really matter where exactly you are. It just matters that you are aware of the different approaches and how that can evolve over time. And what I like about the graph that Andreas was just showing before is it hints to something else, which is, as an angel, if you haven't been investing for a while and haven't been in a company that is an incredible tech success story and has generated like huge amounts of returns for its investors, how do you know how to recognize those, right? And it's really hard to recognize because these aren't consensual typically, right? And so the core underlying concept that I really love about this average Joe is to put yourself in a position where you are quickly exposed to enough deals to start seeing that and then be able to reflect on that and then adjust a more kind of focused investment strategy based on your skills, expertise, whatever that is, right? And I think that's really important. It's just a part in the process of being an angel, and it's not that it's right or wrong, right? Because some profiles that only do it a part-time, they may never go beyond that approach, and that's absolutely fine, right? I just wanted to add that because I think it's really important kind of comment to include.
So now I will actually skip the next slide with this data because I want to get us to the Babe Ruth, so we can also get to talk about deal dynamics because I think that's something that too few people talk about in fora like this. So Mark, give us the outline of the Babe Ruth strategy.
Yeah, so Babe Ruth is, of course, like once you have mastered like all the small aspects of angel investing, you want to transit towards becoming a Babe Ruth investor. So I think, yes, you can bloom from being an average Joe into Babe Ruth. The main difference is the compressed portfolio. I think it was Peter Thiel who as well said, like, look, I want not to invest into 50 or 30 companies. I want to invest into the 10 best companies. This will give me the best returns. Here again, if you think about it, if you hit one outlier, the effect of the outlier is tremendous. If you have a portfolio of 50 companies and you hit one outlier, well, you're de-risked, but the outlier effect is not as hard as if your portfolio would be more compressed. So the first main differentiation point is the size of the portfolio. You're more compressed than the average Joe. The other one is you do selected value bets. Exactly what I said before. You have derived your investment criteria looking for a specific set of entrepreneurs in specific markets with a specific business model or even revenue model. And you kind of derived your own superpower and your knowledge base where you have your own network. So you can as well help entrepreneurs get off the ground. You might be able to give them access to fantastic VCs, construct or like put rounds together. So you already have a skill set which you achieved, and you can actually proactively help entrepreneurs. One thing which I always like as a comparison, if you start as a race driver, like racing cars, like obviously you make lots of mistakes. You make very severe mistakes and crash your car because you don't have the experience when there's, I don't know, lots of water on the street, when there's ice on the street, when you go too fast into a curve. The farther you mature as an angel, the more you know how to handle the situations. And these situations as an angel are very important. I give you a very recent thing which I've seen. We had a stellar setup of VCs and people on on the cap table, and the company was literally running against the wall. Everybody could see it, nobody said a word. So me, as a very small angel, was the one who called like a shareholder meeting and say, hey guys, I think this company is going bankrupt. Can we please do something? And I mean, as a non-experienced angel, you're like, oh, I have a small allocation. What should I be doing? I should maybe not say anything. The other people are in the driver's seat. No, you're in the driver's seat. Everyone is in the driver's seat. If you're on the cap table, whether you put 5K, 100K or 2 million, you should say something if something is not wrong. And this is what I mean by you gain experience and obviously you become better. And this is something which is crucial, being a good angel, bringing your strength, your network, your knowledge into the game. And when you go farther down the road and think about like how you invest, from being an opportunistic investor, you kind of derive your own thesis, you think about a vertical focus or like a certain industry you have particular knowledge about where you can literally help the entrepreneur. And this is very important because the average Joe angel gives you money. The Babe Ruth angel gives you money, knowledge, network, and everything he can do to kind of create a better company. That's why you have some stellar angels here in Germany or in Europe, which everybody wants. Nobody wants their money. Everybody wants their network and their knowledge. And that's where you have to move towards. We spoke about follow-on investments. And I think this type of angel, as you have a compressed portfolio, you have some money aside, which you save because your portfolio is not that broad, where you can back the proven winners. And these angels are a little more sophisticated. They have more knowledge, more experience, so they can see certain indications and certain like proof points along the way where they say, "Ooh, this is something. If this company takes off, it's going to be a multi-billion-dollar company." And that's where they tend to put like money into follow-on rounds. And it's not necessarily only their pro rata. Maybe there's even oversubscribed their pro rata or put like a random check, which is very high, into that company because they believe, okay, this is the one which will kind of, pay me back 100 times my investment across my whole portfolio. And most of them as well do fund-of-fund investments. Here again, the very obvious aspects of network, deal flow, and so on are super crucial. But some of them as well run a different strategy, as they're very focused on a sector, an industry, a stage. They want to invest into upcoming sectors which they don't understand. So they give money to people which understand. So if you're very specialized in SaaS, early stage, somewhere in Germany, maybe you want to give somebody money for biotech. Maybe for AI, some stuff you don't understand, but which is super relevant, which has high potential, and they would just want to put some money and learn and get access to deals and maybe co-invest throughout that network. So the driver is not necessarily a financial one. The driver is learning, getting access, and here again, diversifying risk and getting access to other upcoming industries, which they are simply not as good as others, such as fund managers.
Now I wanted to pull up this question from Vincenzo. He asks us, and for some reason everyone is using the caveat, maybe this is a dumb question today. Guys, there's no dumb questions. Don't worry, just ask us whatever you have on your mind. Your question, Vincenzo, how do I start the path to be an investor/angel? Any suggestion? I will start with David to go on this one, and then Mark, I'll let you come afterwards.
Yeah, this is a tough one to answer with little context on the individual. So I'm gonna assume the hardest path, which is you are not particularly super well networked in the venture space, you are not particularly wealthy, and you are not particularly like an expert in an area, right? I think that's the hardest route. So like it's really hard to understand, okay, where do I start? Because if you have one of the former, you have the capital, so it's easier, or the people, so it's easier, And so I think the way I would go about it, and the way I have gone about it, is actually just build connections with people who are investing, other angels, and kind of take it from there. Many angels co-invest in syndicate, right? So if I'm an angel and I'm putting 10K into each startup, I might pull together some other friends and acquaintances, and we pull all our money into a vehicle. Founders like that, we can add more value as a group, blah blah. So I think that is the best way forward. And I'm seeing that Vincenzo said I'm a biotechnologist. And so, Vincenzo, I don't know what are you hoping to do as an angel. You could say, well, I want to do biotech. Well, that's cool because you actually understand the technology, so that actually gives you a little bit of an edge where you can help other angels as well understand potential investments. That is actually something you can bring to the table, which is cool. If you want to work closely with funds, you could even kind of try and build those relationships and become some kind of partner or expert, depending on the expertise level that you have and business acumen. But those are definitely the routes that I would see moving forward for you. What I wouldn't advise, and this might be a controversial opinion, so I'd love to hear anyone kind of come back at it, but I wouldn't advise like crowdfunding stuff. I wouldn't advise, pure platforms where it's all about volume of deals. I would really advise working closely with individuals, whoever they are, that have like incentives super aligned with yours, right? So they are also deploying their own capital. They're also kind of taking the same risk that you will be taking as an investor, and they're also on it for either the upside or the learnings and insights and networking that brings. The problem with like crowdfunding and other platforms is that the incentives aren't really aligned, right? And so the risk, I actually think it's a higher risk profile, but that's my controversial opinion. And that for me is the simple way forward. But Mark, I see you nodding and kind of laughing, and I'd love to hear.
No, I'm not laughing, never. Not at you, at least. I think you're spot on. I fully agree. And one thing I always try to keep on top of my head is you're the average of the 5 person you spend the most time with. So if you think about this being an angel, you might want to spend time with other successful angels. Even if you're not successful yet, I know people who never invested and they've been just befriended with lots of angels, which do have the networks, do have the access, do regular invest. And they, from time to time, said, hey, man, can I chip in my 5 to 10K into your check? You've done all the work. You've done the due diligence. You know best. You put your money where your tongue is. So I trust you. So by doing that from time to time, they kind of build a portfolio of 10, 15 companies. And all of a sudden, they realized, hey, man, I have a very cool portfolio. And all of a sudden, there were these guys where other people came to and said, hey, can I put my money where your money is? So it sounds very easy to be befriended and know these kind of people because it's a small set of people here in Germany and Europe. But still, if you go to events, if you start networking, LinkedIn is the most powerful tool in the world. Get acquainted, start working with people, get to know these people, and then start to invest. And that's the hardest part. Start doing your very first deal, putting a big check, 10K you save, 5K you save, whatsoever, and say, okay, I'm going to do a single bet. And that's the worst mistake. Don't do a single one. Start to invest if you have confidence that you can do at least 10, 15 investments in the course of the next 5, 10, whatever years.
Yeah. If anyone hasn't read it, I think that Jason Calacanis' book Angel is super approachable. It's an easy read. It's good fun. There's a lot of stuff that's US centric there that's different for Europe, but definitely a good read for anyone getting started. We've got Jimmy Lunga asking a question that says, as experienced angel investors, do you possess any insights or experience in the African market? Mark has a bit. We will not dive into it because then we could start diving into a bunch of different verticals, especially with this being EUVC. I think we'd also have more people kind of drifting off if we talk too much about Africa. But feel free to reach out, Jimmy. I know people that we can connect you with who knows a lot about the African market and really cares about that. We've had
Can
a
I
similar question
Can I add a comment?
about the MENA region, and same reply there. Shoot it to me, and I'll put you in touch with people that know a lot about that region.
Can I add a comment, Andreas? There, I think like it's a great question, right? Africa, Middle East, LATAM, like these are geos that I personally don't know very well, right? But I think there might be great opportunities there, but I'm just like so far away from it, and that's where I particularly like the strategy of also working with GPs because we know some GPs doing some work there. It's a more concentrated space, so there's less GP. The ratio of GP to startup is very different, right? And so it's easier to kind of know who's who, and then kind of do some work of who you want to collaborate with, and that can be just building a relationship or investing, right? You don't have to fully invest. I also just wanted to add, I've seen some questions about reviewing this and the slides and so on. Everyone, if you want to see the materials later on, that's fine. Just go to eu.vc. It will be republished there. Andreas, over to you.
Now let's go to the open discussion on deal dynamics and evaluating deals. Let us just first define what we mean when we say deal dynamics. Mark, I'll let you lead us through this. So tell us core deal dynamics we're putting on this slide, fundraising traction, composition of the round structure, and timing, valuation, and syndication. Tell us, Mark, why are these the parameters on which we think we should base this discussion?
Yeah. So looking at deals, I mean, we're in a very different time than we used to be. I don't know, 1, 2, 3 years ago. Like looking at deal dynamics 2 years ago, there were startups pitching you a deal. Look, the round is done. You have 1 week. Come in or don't. Don't do due diligence. Give me a check or just don't. And if you're like, hey, I was like, okay, you're out. They just walk away. Today, it's a very different market when you think about it. And looking at the very first point, fundraising traction, it depends when you come into a deal. You might come in very early where people just open up their Rolodex and said, I'm reaching out to first angels. I don't have the network. I'm starting to kind of gain traction here. And you're one of the first ones talking to them. Well, you have time. The dynamics are very slow. You have time. You can look at it. You can see who's picking up conversations. You can actually see how their operational business is developing, if they're already like on the ground or selling a product or service. So it's very easy. If you're coming at the very end of the cycle, yeah, they have a lead investor or like already big checks from angels. They're just like collecting the last 50 or 100K. Then you don't have that much time. So what you usually do is you just say yes or no. The second one is composition of the round, and this drives the dynamics actually. So when you think about it, you have a pre-seed deal and they have a lead investor as a VC, dynamics are quite quick. So everybody's like, oh, they have a lead investor, so they're starting to consolidate the round. They look for maybe some strategic angel investors or value-adding angel investors or 1 or 2 micro VCs. So this usually comes together quite quick. In these days, actually, it's still very slow. It used to be very fast when you had a lead investor 2 years ago, but these days you can have a lead investor still need 3 to 6 months to kind of, get the round together. Then the very important aspect is around structure and timing. So if somebody's raising on a CLA or on a SAFE, well, it can be very quick. They can do a closing with all at the same time.
What's the CLA, Mark?
Oh, convertible loan agreement. So this can be very quick. If you do a priced round and you speak to the founder and say, we have not drafted the transaction documents, you're going to have like at least 4 to 6 or 8 weeks until everything is done and they go to the notary. So the actual structure of the round and the timing of the round is very, very important. Here again, it pays into traction and the composition of the round. And last but not least, valuation. Valuation is super fluid. Looking at it when you think about a SAFE or when you think about a convertible loan agreement. So you actually don't know, the moment when it converts, because they have different parameters on how they can convert. Looking at a CLA, especially, either you have a discount or you have a cap. So you will find out at the moment when it converts. Looking at the priced rounds, and it's a super competitive price. So for pre-seed round ranging anywhere between 3 and 5 million, that will be competitive because it's cheap. Paired with a stellar team, you can be pretty sure that this round will be quite quick if they're actually tackling something which is relevant. And on the other side, valuation is, of course, the main driver. So you can have a fantastic deal if it's overpriced. Even the best VCs will say, can't do it. Or they will just send you a term sheet with a lower price tag, and maybe the entrepreneurs say yes or no. And at the end of the day, I think the syndication part I will pass to you because you're the experts here. And I think these are the core parameters on how dynamics and deal come together. And dynamics, maybe as a last sentence from my side, is like the pace of like a deal. And the pace is driven by lead investors, by stellar investors such as great angels or great VCs. And all of a sudden, you think you have lots of time, but things go like this, and you're either not in allocation anymore, or they aim to close the deal within a span of 2-4 weeks whatsoever.
Yeah.
On syndication, Mark said we're the experts. To be fair, we do primarily focus on venture fund syndication, right? So in that sense, we're not as such the experts. I'll kick it to David in just a second for him to reply. Nonetheless, I would just say that what I am hearing definitely on our podcast when talking to angels is that it's not really a do I syndicate or do I not syndicate. It's what do I prefer and what do I lose when I do it. What you typically lose when you syndicate is that direct connection to the founder. Most syndicates will kind of cut you off from that access point, unless it's because your value add and the founder then explicitly want you, but they're putting you into a syndicate because you're too small in the whole round. But you're losing some rights as an individual if you come through a syndicate. And what you want to be looking at just as much as looking at the startup is the syndicate and what are the terms there and how does the syndicate lead behave? How does the syndicate lead manage that person's syndicates so that you know that you're getting into bed with someone who will treat you well. But David, I'll kick it to you if you've got something to add to this.
No, I think what Andreas just described is very much the standard. There's always exceptions, right? Never forget that. But at the end of the day, syndication is just pooling capital from multiple individuals to fund a startup or a fund, right? You have lead investors and co-investors. Typically, lead investors, they take the lead in evaluating the deal, negotiating the terms, conducting the DD, preparing everything, blah, blah, blah. And then the co-investors typically come in just to provide the funding. Sometimes that is not the case. Co-investors can be more active. It really depends. And then things to be really aware in terms of deal dynamics. There's everything that Marc mentioned that still applies, plus the syndication itself. So the legals, the terms, the structure, all of that at the syndicate level. I often see many getting it wrong, but they don't think about the end of the investment, meaning when we make money, they don't think about the taxation implications of the syndicate structures they're using. I think it's incredibly important. Like if you're investing money, you make money and then you end up paying 50% tax. I'm not sure you're going to be very happy as an investor. So I'd really advise, take your time, work with people that know how to do it, and always engage with the deal leads directly. And if the deal leads aren't willing to give you all the information and clarification that you need, well, maybe you should kind of hold on a bit and understand it better before you commit.
And now I will challenge you, Marc, to kind of, because we're coming up towards the end on this, and we're going to take a question in a second with someone who's asking us, does it even make sense to invest privately given the numbers that we showed earlier? But we'll get back to that question. First, I want to ask you, Marc, to kind of, pull back a bit, look at this from the top and say, okay, so we talked about assessing deals. That's what we're here to look at. Then we started out talking about investment strategies, whether you're a Babe Ruth or an average Joe, and how that impacts how you should then address those deals. What are your perspectives on the impact of your investment strategy? So when let's say you're an average Joe and you're then looking at a deal across these 5 different core deal dynamics, how does that impact it? So let's say you're an average Joe, you're looking at fundraising traction. As an average Joe, what should you be thinking when you're thinking about fundraising traction?
Well, the very first thing you should be thinking of is like whether this deal fits your strategy. So even though you're opportunistic, you still should have like a certain strategy on how you invest. That's one thing. Being an average Joe, like as a matter of fact, let's be very honest. If you put a 10K ticket and just bring money and no other value add, you don't have much saying. Like if you have a very strong VC coming on board, they might even say, no, you can't come on board, even if you're syndicated. Or like coming through like a pool. So the deal dynamics in that manner are very important when it comes to timing and gaining conviction across the deal or like alongside of the deal. So you look at a deal, the deal's very quick and you have to take a quick decision. You don't have time to go deeper. You don't have time to kind of get to know the team better and like whether they're performing or not. So you should be aware of that when you come into a deal at the end of a funnel. You literally do a bet based on your gut feeling. If you come into a deal at the very beginning of a funnel, you see the whole picture. How is the deal coming together? How they're gaining traction? Who's interested? Who's passing the deal? That's the one thing which is very important, and we didn't speak about it. It's like when you're early and you see they start reaching out to the top 50 VCs and all of them pass. It doesn't mean it's a bad deal, but all of them pass. That's an information you have gotten. Just imagine you come into a deal and it's almost at the end of the deal and they only have angels. Let me tell you what they're going to tell you. We didn't speak to any VCs. We didn't want to have them on board. We decided to go with value-adding angels. That's why you only see them. The VCs we're going to onboard on the next round. But if you would have come in early, you would have seen that they spoke to 50 and all of them passed. So you can get a lot of insights. So deal dynamics are very important, whether you're going to actually go into a deal or not, because you have a different set of information going through 1, 2, 3, or 4 months of fundraising, seeing lots of insights which we would have not received at the end.
Yeah, and if I was to add on this, I think that if you think about it, if you look at the first two, fundraising traction and composition of the round, as an average Joe, fundraising traction is something you're going to be viewing pretty far away from the actual deal. And as Mark also said, you're likely also going to come in more towards the end of the round. Same thing on the composition of the round. You're just joining in with the rest of the group. If you're an average Joe, typically. Whereas if you're using the Babe Ruth strategy, you'll often be a lead investor, especially if it's a pre-seed round. If it's a seed round, you might still only just be a small brick in the puzzle. But that means that here you're actually putting together the round. You're part of the people putting together the round, whereas you're not if you're an average Joe. Round structure and timing and valuation, as Mark said, if you're an average Joe, you're a price taker. You're just joining in with the rest of the group on the terms that someone else has set. If you're a Babe Ruth, you're going to be trying to set those terms in many of your deals because you want to be the lead investor. And now let's end this whole section on the question that we got from Wincy. And she is asking, and I'm making a wild guess here on gender. I hope I got that right. Is it worth to invest in private deals as an individual, given the expected portfolio return that we showed earlier on? And also bearing in mind that you have to have a 10-year plus illiquidity phase. Mark, give us your first take on this.
It's a very tough one. So, well, I have a very particular view. If I would start angel investing right now, or like would consider to do that because I have the money and maybe the access, I would probably do it. Why? Because I think the best returns are actually generated in down markets. So if you enter into startups on a lower valuation with very humble, down-to-earth founders, which don't go after hyper growth, but which go after fundamentals, which want to build a company which is in the state of default alive. So they kind of build a company so they don't have to raise more money, but they can raise more money. You have a different set of quality. So if you raise in the upmarket and money is a commodity, it's just vastly accessible. You go out, you burn the money through, you raise more money, you burn the money through, you raise more money. That's fantastic, can work very well, can work very bad. Look at Gorillas as a bad example. Well, they raised a shitload of money, but none of the investors have seen a single dollar. So is it a good deal? No. Does it look fantastic from the outside? Yes. In this market, this kind of company would have not been possible to be like raising money for. So you have a different set. Thinking about the next 10 years, well, maybe there's less liquidity in the market. I wouldn't even say that there's less liquidity. It's just harder to get the money. But if you get money, you're going to build a fantastic company. So I think the rule book on how to invest just changed. If you see a company and they raise a 300K pre-seed round, don't touch it. Unless they can show you they have 18 months of lifeline. So if you invest into a company these days, you want to see that they have the ability to survive for 18 to 24 months to raise again in a different market. And obviously you have to be very sharp on what are they going out with. So if they have nothing today, what are they going to have in 18 to 24 months? So I think to kind of summarize it really quickly, the rules changed a little bit, but it's the most beautiful time to actually invest right now. Investing into a down market and selling in an up market. It's better than just imagine you would have invested 2 years ago and you thought, oh, this is fantastic. There's so much money in the market and everybody raised on a very high valuation and everybody burned through just to fuel the growth. And now they're finding themselves in a market like this, trying to raise on a 20 million valuation with zero revenues. So I think this is even worse than investing right now. But I can time the market and nobody else can. What we just know is like, yes, we're probably a little cooled down, but that's not necessarily a bad thing in my opinion.
If I were to say anything on this one, it is returns are, for most angel investors, not the main driver. Most are doing it for a mix of both strategic reasons and pure pleasure reasons. Meaning it's super fun. You get to work with super great people. That's the entertainment. That's that part, right? It's probably the best hobby anyone can have, right? I think that's at least what I think, and hopefully it'll make you rich at the same time. And then there's also the strategic reasons, which might be your CEO or CXO at whatever company. And if you're investing in startups that are similar to what you're doing, you're gonna get better at your day job as well. And I think that's a very important thing to remember. And I think it's also, when you start out, probably you're not gonna make the best bets of your career, right? But once you get more and more in depth in this field and more embedded into the ecosystems, you're going to see better and better opportunities as well. And that's where I think that when you take the aggregate and say, this is how angel investments perform and this is how funds perform, yes, that's how they perform on the aggregate. But if you're embedded, you don't have to settle for the aggregate, but you definitely have to put in the work to get past the indexing strategies and the adverse selection problems. David, do you have any final closing remarks on this?
Yeah, I do actually, and I'm thinking how I'm going to keep it short, but definitely agree with everything. I also think it kind of overlaps into the personal finance topic, right? Which is how much of your own wealth as an angel you want to deploy into venture, and I think there's a lot that could be said there, and definitely not. Most angels I know, or maybe all angels I know, they are deploying capital in other asset classes. So there is a level of diversification and understanding how the different asset classes behave over time. It's a pure financial perspective, and I won't deep dive. And the last one I'll bring up is not a topic that I love, but I think it is incredibly important for angels, is in many geos, there are actually incredible tax benefits to it. That is not reflected in the numbers that we showed. So in the UK, EIS and CIS-like schemes give you an incredible, I didn't say this, but downside protection, right? In the sense that the tax benefit that you get out of it actually completely changes the perspective on which you need to assess that investment as an individual angel, right? Your own capital. I think that's also something, and the Netherlands has that as well. Portugal has that, Spain has that, France has that, to my knowledge. I don't know if Germany has that, but I guess it has something similar. And so that is an extra layer of complexity to account for sure.
On that note, we will say that this is a wrap. We'll put some key takeaways here, but we'll put more on EU.VC, and the email will shoot out tomorrow morning recapping this webinar. Thanks everyone for joining us. Our key takeaways are, first of all, remember there's no single correct way to evaluate startups. You need to make up your own mind and build your own strategy. What we're saying is just the best approach will vary on this specific startup and your investment strategy. But what you need to never forget is that you need to evaluate startups according to the strategy and approach that you have picked for you. That is the mission that we're on when we're saying this. It's know your strategy and make sure that you execute accordingly. That's the core thing here. Everyone, thanks a million for joining us. We had a ball. We hope you did too.